This is Bazaar Morning Call. Broadcasting live from the CNBC TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC TV18 Motilal Oswal studios. And after a very short 3-day work week, the last week, we are embarking into a full 5-day week, this one. Guys, hi, morning.
Hi, good morning, Prashant. Good morning, Nigel. It's a big week for the market. You have the vote on account, you have the US FOMC policy, and you have slew of earnings. So lots to do, and after a 3-day weekend, it's going to be kind of tough, but we'll make it through.
Well, that's right. It feels like you're back to school and you're going to get straight to the test, right? Because you have big cues coming in, both from the globe as well as on the domestic front, and we kickstart a new series as well. We know the January jinx did continue last one.
So hopefully that is behind us now.
Hopefully.
And February starts on a much more positive kind of a note. So let's just quickly recap a few things and get you prepared for what you need to know. So last week was marked by, it was a 3-day work week, but it was marked by a huge amount of volatility, right? And 600 points, 500 points, I mean, those 3 days were very volatile. But finally, at the end of it, after having said everything, I mean, the Nifty managed to defend the 40-day exponential moving average and it bounced. So that's the last close that you want to kind of take away from the last trading session, which was Thursday. Global markets, so we got 2 days of market reaction to deal with. That's Thursday and Friday. They've been largely tepid. I'll just run you through what happened. The S&P is, up 0.5%. The Nasdaq is down about 0.18%. And the dollar index is up about 0.19%. This is neither here nor there, really. But one asset class which has made a big move is oil. Oil prices in the last 2 sessions are up 4%, and they're now about $83.50, actually closer to 84 now. Oil prices, by the way, are also above the 200-day moving average, and the internal resistance is the November 2023 high, which was about closer to 84.61. So in terms of oil prices, the picture is remarkably and sharply different as compared to where we were when we were trading last, which is last Thursday. So 4%, that's a significant move, and we'll kind of react to that today. Now, in terms of US data was mixed. I mean, GDP numbers beat expectations, but on the other hand, you had jobless claims which rose, and the durable goods data which actually disappointed. So again, there is no one solid key takeaway to say, well, data is good or bad, and then, this is what the Fed will do. By the way, the Fed decision is on Wednesday, and I think that's going to be important from a global perspective. No change in rate is expected, but can we see something in terms of the commentary, etc., which gives you further clarity? The market has priced out rate cuts. I mean, the first cut was expected, early into 2023, but slowly but surely it's been pushed out, and maybe, the Fed itself will talk about it. Big week for earnings in the US as well. You got about 42% of the S&P 500 market cap, which will be reporting numbers. So we'll kind of get that through the course of the week as well. Now, just in terms of levels that you need to watch out for the Nifty, the 40-day exponential moving average, which the market managed to defend, is 21,238. So that is the first level which the Nifty needs to kind of respect, support, and not fall back below. Or if we do, then the recent low comes in at 21,137. That's the second one. It's about 150, 170 odd points out. Of course, on the way up, the 20-day moving average comes in at about 21,630. There are other markers which come in around the same level, about 21,600, 21,630 zone. So I think that's the first kind of significant level which the Nifty needs to clear before one can take a really strong call. For the Nifty Bank, support comes in at the recent low, which is 44,429. This is, of course, the weakest part of the market, really. And HDFC Bank has not been helping, although we did see a bit of a bounce last Wednesday and Thursday. Resistance here comes in at about 45,371. The way I would look at it is, give it time. We're starting a new week. The GIFT Nifty is indicating a 150 odd point higher start. Just one more thing, as we begin this new series, the January is behind us. We are starting with a large FII short positioning. And Nigel will talk more about that in a bit from now. I think the number is about 1 lakh crore short contract, which basically indicates that, you could get a bounce for maybe a day, 2 days, 3 days. It's possible. But is it enough to sort of, give you the base for a sustained kind of a rally? That is what I think I'm really not clear about. And that's why I'm saying that wait for a day, see how the market sort of, lands on its feet as we begin another full trading session. And of course, this is a data-heavy week as well. There is the budget here in India. It's a vote on accounts. I'm not sort of going on about that, but there is the FOMC as well. So lots of big risk events in that sense to deal with. Sonia.
Absolutely. And the GIFT Nifty, the implied opening is suggesting a big opening this morning, almost 130 points in the green.
Yeah.
So we'll take it with both hands, right? We can expect the market to move in the green. But the big question, as you rightly pointed out, is this has been a sell-on rally market. It's been a very volatile market. Will that be the case even today? Time will tell. But it is a big week. There is a vote on account on Thursday. There are no significant announcements expected. And if you go by the historical data as well, you will see that vote on accounts or interim budgets have, hardly made any difference to the market trajectory. But be that as it may, we will still have to track this very closely. There's the US FOMC meet outcome on the 31st as well. There are no rate cuts expected this time around, but any indication of the timeline of when the monetary loosening will begin is something that the street will watch very closely. So in that context, it's an important meet to track. The other thing is HDFC Bank could be in focus. It has been one of the biggest losers in the past many weeks. LIC has now got the RBI nod to increase stake in HDFC Bank to up to 9.99%. Now, important to put it into perspective that this is just a provisional nod at this point in time. It doesn't mean that LIC will go and raise stake, but there could be some sentiment bump up on the stock today, a bounce perhaps, but will that get sold into because of how weak the stock has been? So HDFC Bank will also be in focus. Lots of big earnings this week. Today you have ITC. Through the course of the week, you have Maruti. There's SBI on Saturday. There's Tata Motors. There's Dr. Reddy's, Bajaj Finance, etc. So a lot of large cap Nifty companies coming out with their numbers. And large selling from foreign investors is something that continues. So FI sold over 2,100 crores in the cash markets on Thursday. And if you map the trajectory of the Nifty, right, January has not been great for the market. In fact, the high that we hit in January was 22,097. The Nifty is already down about 3.5% from there. So it's been a kind of a very rocky ride for the market. And perhaps that is something that can continue over the course of the next couple of weeks as well. But today, this morning, the start will definitely be in the green.
Well, that's right. Sonia, the start is going to be in the green, but I wouldn't want to chase this opening, this gap up of around 150 points. And besides, Brent crude prices spiking up and the global cues being a bit of a tizzy. Well, the last hour bounce back that you saw in the Nifty as well as the Nifty Bank, part of that would have to be expiry related. So you pull up the Nifty and the Nifty Bank, just take a look at that. That 3 p.m. move is the reason, in fact, we cut our losses out there. So normally on the next session, you see some bit of that giving back. Next up, the January jinx did continue, because we ended with a cut of close to around 2%. In fact, it was the worst January series in the last 5 or so. So January wasn't a great series, and we had alerted you at the start of the series as well. History suggests it's not so good, but hopefully there'll be a bit of a pullback in February. And I say this because the FIs, they're net short on the index. In absolute terms, the total number of contracts is around 1 lakh contracts on the short side. And when we have seen this in the past, whether you talk about, the November series or the April series, at the start of that, when you've had the FIs being net short, it's not been such a bad thing. So the bulls will say, yes, the FIs are net short. That sometimes provides some kind of a cushion. So let's see how this goes. Currently at around 78%, 108 lakh contracts on the short side. Let's see whether they get squeezed out at some point of time. If that number moves around 85, 90% odd, history suggests, yes, we do get a bit of a bounce. What about the options data? I'm looking at 2 strikes, 21,000 put on the downside, 21,500 call on the upside. Just plugging in those numbers out there. The bulls, they are not prepared for life below the 20,950 odd level because the 21,000 put has a fair bit of open interest. 50 rupees is the premium out there. And the last few days, when you're going to around 21,100 odd, you're seeing a bit of a bounce. In terms of technical levels, you also have the 50 DMA that comes in around that mark. So that's going to be the important. 20,950 to around 21,100. That's the important support zone for the bulls. You'll get confident on the upside once you get past the 20 DMA, which is at around 21,630. Let's focus on on Nifty Bank. Well, that as well has been taking some support at around the 44,400 mark. Last couple of sessions we've gone there and we've seen a bit of a bounce. In addition to that, you have the 200 DMA that was conquered on a closing basis. But let's see whether or not we can stay above that mark. So that's going to be important as well. You have the GIFT repeaters suggesting a 150-point gap up. I would suggest don't rush ahead. Don't go to chase this gap up opening. Wait, if you want to get in, the mark to get in is closer to around 21,100 as the last few days suggest. But you get confident only once you get past the 21,650 odd mark.
Okay, and FIs, they've been sellers in this market for 7 consecutive trading sessions. So there's no reason to believe that this market is going to see a recovery anytime soon. Perhaps you'd want to wait and watch on the trajectory. But let's kickstart the show. It's the start of a very heavy week. On the equities front, we have a view coming in from Mahesh Nandurkar of Jefferies, who says the resurgence of a multi-year capex upcycle implies a robust 6 to 7% GDP growth over the next 5 to 7 years. He says foreign investor positioning on India is light and CY24 should see greater inflows, which should help banking stocks. He likes domestic cyclicals like banks, power, telecom, industrial, property. He says they are underweight on IT, consumer and energy stocks.
Well, you've got more opinion coming in. This is Chetan Shade and Nomura who says that China is up the ante that should stabilize stocks, but medium-term concerns remain otherwise. He says that key US data suggests a soft landing, Goldilocks outcome that should be supportive of stocks, particularly larger markets in Asia ex-Japan, such as Korea, Taiwan and India.
Okay, let's also get you some money market views and tell you how that part of the market is shaping up. B. Prasanna of ICICI Bank says the stronger economic data in the US, moderation in early rate cut expectations and increased geopolitical risks all favor the dollar. He says the rupee is facing pressure from recent equity outflows but remained in a range with the RBI smoothing volatilities. He adds short-term outlook on the rupee remains positive on account of seasonality, impending flows in bond index inclusion and healthy RBI reserves, while rising crude and risk-off on geopolitical risks can be headwinds. He expects the rupee to trade in a range of 80 to 83.30 this week.
On bonds, we've got B. Prasanna who says that local yields traded in a very narrow range as well in wake of upcoming fiscal budget and MPC. He says, though incremental action on the liquidity front is positive, heavy supply kept positive momentum at bay. He's expecting lower gross borrowings next fiscal with the deficit at about 5.3%. He expects range-bound movement going into the events with a 10-year benchmark bond yield between 7.1 to 7.25%.